What's happening, Internet? How's it going? My name is Andrew, otherwise known as Drewicious. I'm here today to talk about the StranglER. It is a strategy, an option strategy that I like for playing ERs. So we're going to go into how they work, when I choose them, and what sorts of risks and results we can get from them. Before we go there, I do need to take care of something first. Give me a second. All right, now that that's handled, the StranglER. I've written this up in a couple of the discords that I trade on, but I do still get questions about this, so I thought it would be helpful for me to go ahead and glitch in the matrix. I'm back. So we're going to be going into the StranglER strategy, and I'll be talking about what I'm looking for. And we're going to play one virtually in on demand, which is, if you've watched any of my other videos, one of my favorite features of thinkorswim. So why don't we jump into the chart here and take a look at what was going on with Meta on the day of their ER, prior to the ER. We'll talk about when the safest time to buy one is if you are going to try and take a position. Time matters a lot, largely because of implied volatility, which is something that increases as we get closer to events of uncertainty such as ERs. And that causes premiums to raise and can cause some very unpleasant side effects after the event if you are not well positioned. So we'll talk through some of that here as we jump into the chart. I do have my multiple time frames up here. My most common setup is the 5, 15, 1 hour, and 4 hour charts here, just so that I can make sure I've got a good amount of context as I make my decisions. Now, you guys know that if you've watched my other videos, you know I typically don't like to take any plays within the first 15 to 30 minutes of the day. I would like the initial volatility of the trading day to calm down a little bit, and that does matter in this strategy. And we'll explain a little bit why that is. Because we're looking for lower volatility, we are going to look for a quieter, kind of calmer period in the day that typically is outside of that trading range. And, and you can see here, if you take a look, I know this is kind of a busy chart here with a lot of, I actually cleaned it up just for you guys. But you can see down here at the bottom, I've got an implied volatility sub-study or a lower study here. And typically, yesterday, or what was this, Tuesday, I guess, or maybe Monday, the implied volatility was really just on the way up. And you can see overall that the overall implied volatility is on the raise, and that is because of that binary event of the ER. The higher they go, the higher the premiums, and the more likely a miscalculation can result in you losing money, even if you're right, which sucks when that happens, but it is a possibility. But what we are looking for here is a period of lower volatility, and I typically tend to assume that those happen right around lunch where things are calmer and there are fewer trades and lower volume going on. So we're going to look for midday or at least after the open for us to grab our positions. Now, in this case, we're about 30 minutes into the trading day on that Wednesday, this past Wednesday before the ER. Now, because I'm in virtual here, I'm already in. I will show you the contracts that I'm currently in. I picked these up on a previous run of the video, so I'm not cheating or anything here. But you can see that I picked up a 127 call and a 140. I'm sorry, a 127 put and a 140 call. And you can see that I'm about even. I haven't moved too far. But let's go take a look and discuss how and why we landed on those strike prices. Now, right now, because we're in on demand, we don't have the benefit of a very small but super valuable feature on thinkorswim called the market maker move. And it shows up whenever a ticker is getting more action, more activity than usual, or if there's a big event like an ER coming up. Now, what that market maker move does is it forecasts the implied move of the ticker for the event coming, and that typically will show up as a positive or minus, right? So we would anticipate that this will move plus or minus 5%, plus or minus 10%, plus or minus 15%, right? We can use that number, that implied move, to help us pick a safe strike price, or what I like to call the strike zone, where we can pick something that gives us a good chance of landing in the money. It is critical that one of your legs lands in the money in order for this strategy to work. Because we are essentially playing volatility, we don't care if the ticker goes up or down. All we care about is that there's a big move. Because what's going to happen is once one of those legs goes over 100%, it pays for the losing leg, and anything over that is just risk-free profit, which is my favorite kind of profit. It should be yours too. So we are looking for a safe strike price, because if we go too far out of the money and we get a big move that goes in that direction, the IV crush can still mean that we are not profitable. And that has happened to me before, and probably will happen to you at some point as well. The biggest risk with this particular strategy is that there isn't a move, or there isn't a big enough move to put you in the money on something. So with this strategy, you can absolutely be right and still end up losing money. So that is a risk. There's a risk with any play, especially with options. And so hopefully if you are dabbling in options, you understand that already. Whatever you put on the table is money you are comfortable losing, with the hopes that it does come back to you, with the plan of it coming back to you. So back to how we pick our strike price. In this case, I think Meta had a market maker move. They were forecasting about a 12% move. Now, I do not like to say, well, then I'm just going to pick a strike that's 12% out. That is very risky, because what if it's a 10% move? IV crush will take your money. What if it's an 11% move? IV crush will take your money. So what I like to do is take that implied move and go about halfway, right? So on a 12% move, I'd be looking for about 6% off of the current price in order to get something that has a higher likelihood of landing in the money, thereby giving me above 100% return on one of my legs and thereby making the trade profitable. So we're going to use some very sloppy math here to determine how we landed at the strike price, right? Now, if we go back and look at it, we picked a 140 call and a 127 put. And if we go here and take a look, there's our 127 and there's our, well, 140 is just out of the range here. But essentially, at the time that I took these contracts in my virtual account here, the 127 and the 140 were about equal distance, about equal delta away from in the money, or at the money. And so, and their premiums were about the same. They were a little bit different just because of the way that the delta ramps are set up here in this particular premium, and what was already going on, or in this particular ticker, and what was going on throughout the day. But ultimately, generally what I'm looking for is to make sure that I spend about the same amount of money on my put as I do on the call. That puts me fairly evenly balanced. Now you can slide those around a little bit to give yourself a bias. If you're really expecting a beat or you're expecting a miss, you can sort of favor and bias there, place a little bit further out, because that move can be more profitable. There is more profit in being further out. There's also more risk. So in order to mitigate some of that risk, I like to come back in a little bit. So I picked about 5 strikes up and down from at the money. That's how we landed at our current strike prices. So if we go back and we take a look, we can see that, currently we are a little bit down. The call side has lost a little bit more money than the put side. So I am not worried about that because I'm waiting for the play. So if we go ahead and jump to the end of the day, we're going to jump over to our flexible grid here, and let's go see how things are looking by the end of the day. Now, it's not critical how we're looking at the end of the day because, like I said, our ER is after the close of the market. So we will actually find out how we're looking once we get to tomorrow morning. But if we take a jump here towards the end of the day, we can see that Meta is still trying to update itself here. The chart is struggling. We'll give it a couple seconds here. But I can tell you what happens here because I remember the trading day. It was just a couple days ago. We had a bit of a run up and then we had a bit of a run down. And here we go. So there we can see the move. So we moved up a little bit and then we came down a little bit. And there's been a fair amount of volatility in this day. So it wasn't an ideal day for buying these strangles. But again, I felt that this was a great candidate for a big move because it has had a lot of movement. There are a lot of expectations, and it is considered one of the larger tickers. And I felt like they were facing a lot of headwinds. I was personally expecting a miss, but I wasn't willing to bet on a miss. That is why we find ourselves here talking about strangles. All right, so we had a move there. Let's just see how things are looking towards the end of the day. You can see once again that we're about even. We're at 140. on our puts, and we're down 153 on our calls. Again, relatively even. We're down $13 so far on a $1,000 play, so that's not too bad. And the risk here, as I said earlier, is that if there's barely a move on this, if the ER just sort of doesn't impress anybody, I could lose all $1,000, right? These could both go to a much lower amount, and I could be out all of that cash. That is the risk with the StranglER. But I'm really fairly confident, I was fairly confident this week, that Meta wasn't going to have a quiet ER. So let's find out what happens to our ticker here when we go to the next day and we jump to the start of the market. So let's go ahead and jump right into 8:35, 5 minutes after market open, and let's find out what happened to our premium and to our ticker. So anybody that was paying attention, you know that it was a massive, massive gutting. Meta had a terrible release. They dumped a lot. They continued dumping all the way through post-market and in pre-market, and opened up below $100. So it was a fairly epic meltdown. And we're going to jump over and find out what that did to our contracts. So there's our put that we bought for $4.95. It is now worth $27, almost $28. And our call there that we bought for $5.50 is worth about $15. Now, we are giving up the fact that we are basically 100% loss for our call. We are making up for that by the fact that we just had about a 520% play on our puts. So this was obviously fantastic profit margin here. You know, we spent about $1,000, a little over $1,000. We made $2,700, almost $2,800, right? I will do that all day, every day. Now, this doesn't work on every ticker. I have played strangles before where I did get the Met ER and I didn't do great on either leg. I've also had strangles where I've made money on both the call and the put side by being patient. There are a number of ways for that to play out. But again, the important thing and what we're looking for the most here are high expectations, emotional reactions, and hopefully emotional overreactions. So, you know, look through the headlines, look to see who's talking the most, look to see who's got the most disagreement around it, and where the amount of attention seems disproportionate. That gives you a better chance of getting a ticker that is going to have an oversized move and give you an excellent play opportunity like this. Again, bear in mind the risks that go along with this, right? No options play, no stock play is without its risk. Options are even more so. But this does take away the risk of having a directional bias, an overly stated directional bias, and being wrong, right? Because if I had taken calls, if I felt in my bones that Meta was going to moon, and I took calls, you see here what would have happened. I would be out all of my premium. But because we picked a good strike price and we managed to get a big move, we had a very profitable play. So ERs are coming up next week. The ERs will be coming up all the time. So I hope that this helps you guys think about what to look for in a ticker, what it is that you can find that might be helpful as you approach the remainder of your ERs. And I hope that this is something that is beneficial for you in your trading arsenal. If you have any questions or comments, please leave them down below. I will definitely try to get back to you guys. If you have ideas on other videos, I'm open to those as well. Otherwise, please click like, subscribe to the channel, all that kind of good stuff. I will see you guys on the next video. Take care of yourselves. Until then, skål.